The third and last type of chart that we're going to talk about today is the line chart. And remember, the closing price is the most important price of the entire period. So if we're looking at a daily chart, the closing price for that day is by far and away the most important. And the reason is because the entire world has collectively decided that the closing price for that day is where that price belongs. Where it was earlier in the day is not as relevant as where it ends that day. If we're looking at a weekly chart, it's the same thing. The closing price on Friday is going to be much more important than where it is on Monday morning or even Tuesday or Wednesday. That closing price is what we're looking for. And that's the huge advantage of the line chart, because what a line chart does is it just connects the closing prices for all of the periods. So if we're looking at a daily chart, it connects all of the closing prices for all of the days. And if we're looking at a weekly chart, it connects all of the closing prices for all of those weeks. Here's a great example. You can follow me here. This is a line chart of the S&P 500. This is the highs in 2007 and 2008. And you can see here that you have a beautiful uptrend where the line chart is connecting all of the closing prices for the S&P 500 index and the major topping process that took place in 2007, 2008, and obviously the crash that ensued. But what I really want to focus on is that all we're doing here by eliminating all of the noise is just looking at the most important price for that day, the closing price. One of the biggest reasons why we want to use line charts is when we're comparing two assets, when we're looking at ratio charts. In this case, we're looking at the financials exchange traded fund relative to the S&P 500 exchange traded fund, the XLF versus SPY. And the reason we want to use line charts is because they're going to open at different times. They're exchange traded funds. In some cases, we're looking at an ETF that represents a country overseas. In some cases, we're using ETFs that represent perhaps a commodity or a currency, but maybe something that was trading overnight, not necessarily in this particular period. So because you're always going to get gaps because the opening prices are different, in order to eliminate that noise, we want to use line charts. If we're using bar charts or candlestick charts when we're comparing two assets, that data is not going to be reliable. We want to focus on line charts when we're comparing two asset classes. So in this case, we're looking at financials relative to the S&P 500, nice beautiful base in early 2012, and a base breakout. This is suggesting to us that financials are outperforming the S&P 500. Here's another great example of how we can incorporate line charts into our process. In this case, we're comparing two different asset classes to one another. We are looking at 30-year bond yields in the United States. And down below, we're looking at a ratio of Treasury inflation-adjusted securities, right, that are treasuries that are adjusting for inflation compared to your traditional U.S. Treasury bonds. So you have a lot going on with price. Three different things are being compared, but because of the simplicity of the line chart, you can very easily see the correlation in this case of 30-year bond yields and then where the market thinks inflation is going. Many cases, you can see that the correlation is very exact. I can show you guys 1,000 of these examples, and the line chart really allows us to visualize that correlation. And then in this case, I want to finish off with gold relative to U.S. Treasury bonds. This is another ratio chart where we're comparing asset classes that are vastly different. In one case, we're talking about bonds. In another case, we're talking about gold futures. If we use candlesticks or bars to create this ratio, we would not have reliable data because the opening prices and the way they trade and the times that they trade are substantially different. So by using line charts that were only focused on those closes, we can't use other types of charts. We're forced to use this one. And finally, in order to help recognize that we are in an uptrend in this case where gold has clearly been outperforming the U.S. Treasury bond market, is to bring in moving averages. This is a smoothing mechanism that allows us to eliminate the day-to-day or week-to-week noise in a given market and essentially smooth that out.